So, first of all, welcome again to our Client Investment Seminar. It's our fourth investment seminar that we've run so far, our second with Pacific Asset Management, our investment partners. So, really thank you very much for coming. Some of you have been here previously, so you've come again, so that just means you might have enjoyed the last one. So, hopefully we'll give you similar type of input and similar type of experience. The agenda for tonight is I'm going to talk a little bit about where we are as a firm, and then I'm going to hand over to Matt, who's going to give you an update of Pacific and a bit about the markets, and then the two Wills will tail up the seminar with more market updates, and we'll talk about sustainability in your investment portfolios, which is a big part of our portfolios and why they've done really well over the last few years. So, without further ado, update from where we are in terms of Moneyweb. So, in terms of business, we continue to grow, very, very strong in terms of client acquisition and also in terms of growing wealth individually. So at the moment, we're looking after £265 million of clients' assets. And within that 265, we've got 141 of that managed by Pacific Asset Management. What that looks like for us as a business, that gives us nearly 1,000 clients, which when we're quite a small team, it's very difficult to ensure that our clients get a really good service. And that's really important to us as a business, to ensure that the client journey and client experience is second to none, which is why as a business we invest heavily in staff. And we're always looking for top quality individuals to come into the business and take on certain roles. So we have a fantastic team of advisors, we have a fantastic team of administration staff, and we have a good team in the back office in terms of the client communications. So as we grow, which we considerably have been doing over the last few years, we'll just need to make sure that that team grows with us. So it's really important for me as the business owner to make sure that none of these guys leave, because we want to encourage them to stay. But more importantly, we need to make sure that we can have a young talent coming to us with a bit of experience, and they can come and join the team and move things forward. An element that's been growing for us in the last 12 months has been the corporate pensions market. Now, some of that doesn't affect you guys here, but I just thought I'd give you some figures around it. So we have a proposition looking after company pensions. So we're going around speaking to companies and business owners in terms of managing their employees' pension schemes. So at the moment we stand at £14 million with 50 schemes and 1,400 members. So for us that's a really great area that we want to try and develop. So Sasha, who's at the back, will probably be the first at the bar after everybody's finished. She heads up that administration platform and is very good at it. And we'll continue to grow that side of the business. And probably in time we'll increase that team. And something that we're developing at the moment, so at the moment I would imagine 95% of you sat in this room have your assets managed through a platform that's no doubt either been Aviva or Quilter's. And that's great, we have some great terms with Aviva. We're trying to squeeze them as much as we can in terms of cost, because all Aviva do is a platform. They're just managing money on a platform. They don't offer you anything else but the management of that. And that's cost driven really. So yes, it's got to have a good service around it, but it's mainly down to the cost. So if we, with our investment partners, can find a solution where we can develop a platform that may be cheaper for you to hold your client assets on, then we think that's a good thing. So that's something that we probably might talk about next year. We're very close to securing a deal with a company that might be impactful for you guys in terms of where you hold your assets. The investment mandate around them won't change, but the administration platform might change. So more on that in due course. In July, we won an award, and we're very pleased to tell you about it. So Financial Times Advisor, FT Advisor, voted as one of the top 50 boutique advisors in the UK. It's an award that we're really pleased to secure. It's an award that demonstrates growth in smaller investment companies or smaller IFAs. So we're not at the stage where we can work with the big boys yet, but I think for a company based in Scarborough in North Yorkshire, I certainly feel that we punch above our weight in terms of what we do, and this is accolade sort of backs that up. So we were pleased to get that, and hopefully we'll get some more in the future as well. New team guys that have come to us. So Thomas is at the back. We've got Tom. He does most of my work now. So my clients who are sat here, and there's many of them, you'd have been looked after by Josie for the past 6 or 7 years, and has done a fantastic job, but she's changed teams a little bit. Still with Moneyweb, but working for somebody else within the team. And Tom now looks after my clients. So if you haven't seen or spoke to Tom, he looks like that, a bit like Tom Selleck. Tom's fully qualified and does a great job in terms of administration. He's aspiring to be an IFA, but at the moment we're going to keep him where he is because he's doing a good job. And the other two younger guys that you can see there, Will and Harry, they've joined us both in the last couple of months, so they're administration staff. Harry's on the client comms team. He'll pick up the phone when you guys ring. He speaks like that quite a lot, if you've spoken to him in the past. And Will's on the advisor support. So Will's just been in York St John College, got all his exams, and going through that process at the moment. So those are the newbies. On top of that, some big achievements for Elliot. He achieved chartered financial planning status this year. So I'm really pleased that he got over the line. It's quite a big achievement for us to get somebody as a chartered financial planner within the business. I think Elliot passes exams like some people eat hot dinner, so he's very, very good at passing exams. And also Beth, my daughter, most of you hopefully might know her, she took her last exam on Tuesday. Hopefully, fingers crossed, touch wood, she'll have passed it. She gets to know in November. And part of the process for Beth is to work directly alongside me with my clients. Okay, what we've been doing in the community, we still are proud supporters of Scarborough Football Club, Scarborough Rugby Club. We supported the Jubilee at Ayton this year, and also we've got behind Racing Welfare with a bit of support for them. I can't take the credit for the top two in the fact that they're doing so well at the moment. The rugby club haven't lost a game, and Scarborough Football Club, I think, are third in the league. So I don't think it's our money that's helped, but I suppose everybody else's does. Tree planting, which is part of our sustainable culture within the business, and we share that responsibility with the guys from Pacific Asset Management. You might know that for every tree we plant, every portfolio we take on, we plant 2 trees. So we plant a tree, and Pacific help us plant the second tree to that. We had a relationship with a company called Nidderdale, which are a company based over near Harrogate. And unfortunately, or fortunately for them, that responsibility is now stopped because we've planted over 2,300 trees with these guys, and there's no more places to plant any more trees. So we've had to find a new partner this year. So we've got one, which is Green the UK, and we've just sort of secured that deal in the last few weeks, and we'll continue to plant trees once portfolios continue to increase. So with that commitment of 2 trees for one portfolio continues to be the case. Invest in the future. These guys are who we support. These are young athletes doing various different disciplines. Golfing, rugby, and 2 equestrian riders. We support those as much as we possibly can in their chosen disciplines. Just to pick one out there, Steph Else, which is the lady in the rugby top. She's just got onto the England pathway for the England under-21s. So she's doing really well. Jack the golfer plays his golf over in America. And then we've got 2 equestrian riders, Hannah and Emily. I think Emily's grandparents are in here somewhere. Where are they? At the back there. They're not standing up. So these guys are doing extremely well on horseback, and that's a sport close to my heart, so that's why we support those guys. Charity-wise, these are the guys that we've supported this year. So if you remember last year, we had quite a big charity event. We raised over £40,000 for St Catherine's Hospice in that particular year. Our charity side of things this year has slowed a little bit because you can only ask, you can't go really back and asking the same people all the time for money, much as I'm quite good at that. But I think we've sort of taken a bit of a back seat on charity, but we've still supported Andy's Man Club, the Stroke Association, Martin's House, and Scarborough and Whitby Rydale Mines. So to date, our total funds that we've raised for charity stands at 109,000. We're really, really, really pleased with that, and we'll continue to do that as much as we possibly can. Okay, that's enough about Moneyweb. Let's talk about what you've come here to talk about. So that's the relationship that we have with Pacific Asset Management. I'll go back to the same slide that I spoke about last year, which was price, service, and performance. So I'll get a bit of audience participation here. If I can have a show of hands, out of those three, who thinks price is the most important? Good, nobody. Okay, who thinks performance is the most important? Okay, that's a good half. And who thinks service is the most important? A few of you. Who didn't put their hands up? A few of you. Okay, I think service is the most important because without service, the other two don't arrive. So that's not just our service to you guys, which I would hope that you would find should be top drawer, but it's also the service that these guys give to us, because if these guys don't deliver the service to us, we can't then pass that on to you. So I think service is really important for us, but if you were looking at that, and a lot of people do look at it, a lot of people are price sensitive, and we are still, and we'll try and drive prices down as much as we can. These guys worry when they come up to Yorkshire because they know that we're going to ask for a discount on fees all the time. But we've got a really competitive and compelling mandate that we run. And just to reiterate in terms of performance, so this is our performance over the last year. You can see that big trough there, which we didn't like. That was Trump's tariffs, which Matt will talk about later. But this is our balanced model, which 65% of you sat in this room are in. So that's the middle of the road. It's risk profile 3. So if you remember when you have your annual reviews with your advisor, and you go through that little document about what number you are, so the majority of our clients sit in the balanced risk, number 3. And we've returned 10.25% this year, so that's from the 30th of September to the 1st of October. We're really, really pleased with that type of performance for a balanced portfolio. And you might say, well, that's great, Paul, but what's that relative to? Because if everybody else is doing 12, then you're doing rubbish. So we benchmark against a data piece called ARC, which are Asset Risk Consultants. And what ARC do is they go out and find all the other balanced models in the UK, and then they plot that as an average. And what we want to try and do is be above that average all the time. So overlaying that graph, which is the red line there, if you can see, that's the balanced ARC, which is 6.95. So you can see we're well above the average. And then for those of you who've been clients for a long time in these models, you probably might remember that our previous investment partners were LGT Wealth. And we changed 2 years ago in favour of the guys that are sat over at this table. And this is the last time that I'm going to produce this graph to demonstrate that it was the right thing to do. So that's the performance of LGT's models over the last year. So it's less than what the average is. So I think that slide is probably the most important slide in terms of performance that you can ever see. It tells you that the changes that we made 2 years ago was the right thing to do. It tells you that we're above the sector average, and we've been above the sector average consistently throughout the lifetime of looking after these investment portfolios. And one of the final slides on performance is what we've produced in terms of more than the benchmark. So on the right-hand side, if you looked at the balanced portfolio, this year we've done 3.3% more than what the average is. For those of you who are taking bigger risks, the difference is even bigger. So for our top level of risk, which is our aggressive, which is risk level 5, I don't know there's many people in this room that are on that level of risk, but if you are, you've outperformed our benchmark by 4.3% this year. So you've returned 13.6 against the average of 9.3. So I'm quite pleased with those figures, and hopefully long may they continue. These are the guys that are delivering the returns. On the right-hand side are the guys from PAM. On the left-hand side is the investment committee from Moneyweb. So you can see there's more guys from PAM, less from us. So we don't have the power to outvote them in the decisions. But what we do, which I think is really important, is we have the ability to challenge them on decisions that they're making. And the good thing with that is they do listen to us, which I think is really important. It's a two-way street. We don't get railroaded to do something that we don't want to do. And the relationship is very, very flexible. We meet once a quarter. You guys get the feedback from that every quarter in terms of the changes we've done and the rationale for change. So when we sit down with you, and sometimes we sit down in a meeting and we'll say, there's no changes, we don't need to make any changes, we're pretty happy with everything. That doesn't mean that we have not made any changes to the portfolio, because the portfolios are changing frequently, and we'll talk about that later on in tonight, about the changes that we've made in the portfolios over the last 12 months. And not only that, the impact that those changes are deriving on your returns. So the relationship is good, it's strong. We hope it continues, we're sure it will do. These guys love working with us, and we love working with them as well, and that's what's delivering the returns for you. I think that's enough from me now, so I'm going to pass on to Matt, who's going to tell you where PAM are really, in terms of where they were last year to where they are now, and thank you very much for coming.
Thanks, Paul. Good evening, everyone, and thanks for coming. Thanks for listening to us. Paul, as always, sort of undersells himself a little bit. He said that they're in the top 50. I just Googled just now to see how many financial advisors there are in the UK. There are 35,650 financial advisors in the UK. So if you're in the top 50, that's pretty amazing, in my view. But I'm going to talk a little bit about PAM and sort of where we've come from, and then I'm going to talk a little bit about risk. Then I might ask you a couple of questions, a bit of audience participation, and then hand over to the brain boxes to be able to try and answer them, or at least put them in the squeeze box. I founded Pacific Asset Management in 2016. Prior to PAM, I was at a business called Deutsche Bank, where I looked after their alternatives business. I got a phone call from a very wealthy man who ran a family office, who was extremely disillusioned by what was going on in asset management. And he said, Matt, would you be interested in starting an asset management business? And my immediate response was that that's going to be way too difficult. It's massively industrialized and everybody does the same thing. So he sort of was a bit disappointed. I was sure my wife wasn't too happy about me leaving and starting something new either. But then he said, humour me, what would you need to be able to do this? And I've never been particularly financially motivated as a person, in hindsight. It was probably a mistake. But I said there's three things that are important to us. The first and foremost is that everyone in the business needs to be aligned to the business. The sort of rightly, the kind of get-rich-quick scheme is gone, and if you've got to get rich slowly, you've got to get rich with people you like, people that you can work with, people that kind of are passionate and embedded and aligned with everything that we're doing. And the most important thing was culture. And he says, so culture is the thing that sort of defines us. It's the thing that I think probably is the reason why we get on so well with the team at Moneyweb. You can hear Paul speaking, it sort of underpins everything he does. We're a management-owned business, and as soon as we're not, that's when Paul needs to sell, because that is what drives our success, I think. The other thing is technology. There we are. I did maths and technology as a student and at university, and if we were unencumbered by legacy, then the most important thing was to use technology. People really care what you pay for something, but they don't care how much money you make out of it. Margins is not the issue, absolute price is the issue. And what Paul wants is us to use technology so that he can continue to get the price down, which ultimately has an impact on your returns. And that is the most important thing for us. So we're one of the leading technologists in the asset management industry today. In fact, my technologist told me the other day, we process 344 million data points every single day. We now automate 12,500 materials for other financial advisors in the UK. And the last thing is conviction, he says. So we wanted conviction in how we invest, conviction, importantly, in those other 2 points as well. And after doing that in 2016, this time last year when I stood up, we ran £5.8 billion. And we do really 2 things. One is provide solutions for financial advisors like Paul. We work very exclusively. We choose who we work with. We don't work with everyone. You can't buy us off the shelf. We want to work with people that we enjoy working with, that we have fun with, that are sort of intellectually as nerdy as we are, because that to me is the bit that creates great success. The other part of our business is where we run individual strategies for very large pension funds. So we run money for US pension funds, Canadian pension funds. We run the balance sheet of one of the largest insurance companies in the world. We run money for sovereign wealth funds in the Middle East. And that was where we were last year. And 12 months on, we now run £12.2 billion. We're now the fastest growing asset management business in the UK. So it's been a massively exciting journey. And all of those things, the growth has been fairly even, both on our institutional side and our solutions business that we run with firms like Paul. I should say we only work with 20 financial advisors in the UK. Something we're sort of, you can't deliver the service that he talked about if you work with millions of people. So I'm going to talk a little bit about volatility. Now I can tell you what volatility is. Volatility is measured by this. That is the formula for annualized standard deviation. And effectively, it's the sort of spread of returns around the average return. But that is sort of irrelevant. What is volatility really? Volatility is just a measure of predictability. It's not even really a measure of risk. And no one uses the word volatility. You should think about the word predictability. I don't go, hey, I'm going to Dubai because I love it. The weather's super low vol. You say, I go there because it's pretty predictable. You know, some of you are racier and you're going to go for your holidays in Scarborough where the weather might be less predictable. But everyone knows what they like. And volatility and controlling volatility is massively important. And the reason why it's unbelievably important in the context of what Paul does is because whilst it's super sexy to talk about markets and what's going on in the world, the single biggest differences that will make to your portfolios are actually the advice that Moneyweb give. To give an example, my father got terminal cancer and he passed away. And he had bought a house, a little flat in London with my mum in the 60s. It was now worth like £500,000 and they bought it for like £20,000. And they owned it each in their names. And it was sort of his retirement pot. And we knew he was going to pass away. And a financial advisor said to me, you need to put that in his name so that when he passes away, he could pass it to my mum tax-free. And that's what they did. And my mum sold it and didn't pay any capital gains tax. They saved £85,000 in capital gains tax. My dad sold tractors. I mean, if he was in our balance fund, I would have had to wait about 35 years to make him 85,000 quid. And a financial advisor did it in about 35 minutes. And so the most important thing, in the financial industry, they use a term called alpha. Alpha means unexplained outperformance, i.e. it's skill. And we have a saying that the alpha is actually in the advice. The vast majority of what happens to your portfolio is defined by what you can control, which is tax planning. Our job is to take that and then sensibly, cost efficiently, and compound those assets in a super predictable way. Because if we're not predictable, then Paul can't do his financial advice piece. And that's why understanding volatility and predictability is important. And the reason why I want to talk about it today is because there are people like this in the world, yeah? Which makes it legends like Trump, which makes it very difficult to navigate financial markets. In fact, there's also UK inflation worries, more Trump worries, China stock worries, Farage worries, Starmer worries. There's pretty much everything. And top it all, Donald Trump thinks he should get a Nobel Peace Prize. So it's a pretty volatile time. I don't envy the Wills navigating this. But Paul showed a chart, and I'm going to show it returns, show it again this time, but in a second. But one of the things that's absolutely important is that you need deep investment expertise when running portfolios in these markets. But equally important, you need really strong maths and risk management. Because if you don't have maths and risk management, you're just speculating. And no one's right all the time, however wonderful they are. And it's that combination between deep investment experience and risk management and maths that makes a solution. And that, I think, is what's different in the way that we've worked with Moneyweb and how we've tried to build portfolios. And to me, the real artwork is this chart here. So this, in investing world, is like a little Picasso. Because what this is year-to-date performance of the different Moneyweb models depending on how much risk they've taken. So if you're in the low-risk model, what you can see is that by the time Trump had his Liberation Day, and then a couple of days did the Trump always chickens out, the lowest risk portfolio lost virtually no money at all. And the highest risk portfolio lost maybe 7 or 8% peak to trough. And then, of course, these guys navigate the ship, it goes through, and now the best performing is the aggressive portfolio, and the lowest return is the defensive portfolio. That's predictability. That's what's unbelievable. That allows Paul to do his job, to make sure that we can be predictable. And in the end, all of them have outperformed cash, assuming you could get cash in a bank, which I've never seen before. But so that, I think, is massively important, that when you're running money, it's about having that sort of fan of returns, because that is a sign of predictability. And there were many portfolios in years like 2022 where the lowest risk portfolios lost more than the highest risk portfolios, which makes it really difficult for financial advisors and clients to plan their future. And if you look since we've taken over, that fan has worked in exactly the same way. So as Paul thinks about planning and think about outcomes, which is the most important part, and the controllable aspects of tax planning, our job is to make sure that we can continue to deliver these sort of super predictable returns so that he can do his job. So it sounds pretty boring, but that's what predictability is, and I think is more important in today's market than ever before. This is the sort of another way of visualizing it. Along the bottom is that level of risk. To the right, higher risk. To the left, as you're looking at it, lower risk. And then the returns of the strategies. And the perfect portfolio is when all those dots can line up nicely like that. You're getting paid more for each unit of additional risk you're taking. And that, I think, is what the guys and the team at PAM have done incredibly well with. Predictability, this is another way of showing why predictability is important. Anybody who's been on the LNER, it arrives 75.2% of the time. The pain of loss far exceeds the pleasure of gain. That is, and we all remember when stuff goes wrong, even if it's 75% of the time, it's right. And the biggest companies in the world, Amazon, DPD, delivering at 95, 96, 97 plus returns. It's not going to last forever, but what we can tell you is that 100% of portfolios at PAM have outperformed their peer groups. And our job is to stick between that 97 and 100% type predictability, because if we can do that, then people really thinks it works. If we're down at 75%, then people will remember when we've got things wrong, and that's what we've got to try and avoid. I hope that made some sense. Now, I believe, I'll do a quick question. This is my quick question. Can everyone stand up? I've got a question for you. Okay. Right. What I want you to do is that for those over the next 12 months, For those that would be happy with 5% returns, sit down. Okay, so over the next 12 months, you've got 5%. For those of you that would be happy with 10% return, sit down. Okay, there's a few greedy ones out there. So, okay, there's 4 or 5. They need to be in the highest risk portfolios by the looks of things. But there we are. Cash likely to be less than, more like 4%. Take away the bank's fees, more like 1%. So I think if we can do 5 or 10% over the next 12 months, we'll be hopefully, and we can do it in a predictable fashion. We're going to do it. People should be happy. And the person who's going to tell you how to make 5 or 10%, or even 15%, is going to be Will. So I'm going to pass over to him. Thank you very much.
Okay, thanks very much, everybody. Very nice to see everybody again this year. So I'm going to talk for about 15 minutes, talk a little bit about the team, a little bit about how we run the portfolios. In particular, spend a bit of time talking about the investment committee and how well that partnership works with everyone at Moneyweb. So just to start off with, we always start with the people because this is a people business. People are incredibly important in our business, and the team has grown a little bit since we were here last year. We have a couple of new joiners, but Will and I run the portfolios. Will is our Chief Sustainability Officer as well, but he also runs all the portfolios with me. So we're responsible for the performance of the portfolios. We can't control markets, but we can control the inputs into our portfolios. That's incredibly important to us. And the responsibility is a very large one. We take it extremely seriously. But we're backed up by a very strong team. On the right-hand side, we have our quantitative specialists. So these are the maths guys. Come from different backgrounds, help us with some of the data input we have, some of the way that we run the portfolios from a risk perspective. They're extremely important members of the team. And on the left-hand side, our analysts, Laura, Lucian, and Dan, who's joined us this year, joined actually from another financial advisor, extremely bright, has specialism in macro and fund selection, and he's joined this year, as has Joe at the bottom, one of our portfolio platform analysts. So the team remains very important, as does the broader team at Pacific. So one of the great benefits we have, Matt talked about culture, and culture is incredibly important to us in the business, but particularly from my perspective, from an investment perspective, sharing ideas with other investment specialists. And these guys all run different asset classes there from the right-hand side of the chart that we showed. And you would be amazed how poor many people are in the investment business at sharing ideas. They want to sit in front of their screens all day. They don't want to talk with other people about markets. And we only want people in our business who are happy to share ideas. It sounds incredibly obvious, but you'd be amazed how difficult it is to get people like that. We only hire people who are happy to discuss markets, and that's of huge benefits to us when we're investing, because we meet with them regularly. There are 2 meetings a week where we all sit down and talk about markets, and all of those inputs help us to run these portfolios. The insights into those different specialist markets help us to run these portfolios. So how do we think about portfolios from an investment philosophy perspective? So Matt talked a lot about risk. It's incredibly important to us. And the way we think about all the portfolios is to have portfolios that are as diversified as possible. Before we started, I was talking to some people in the room about how crazy the world is. And the way that we manage that is to diversify as much as possible, to spread the risk as widely as possible. And to think about making money, of course, is very important. We're all here to grow portfolios over time. But the way to do that, we think it's very important to think about the downside as well. So we are most concerned when markets are falling, making sure that we have portfolios that are resilient. And we've had a volatile period this year, and we'll talk about that in a moment. So diversification and thinking about the upside as well as the downside is incredibly important, the way that we run all of our portfolios. I thought I might talk a little bit, though, this time about the way that we run sort of the day-to-day mechanics of how we work with Moneyweb, because it's a very unusual relationship for us. These portfolios are built specifically for Moneyweb and for the clients. So I thought we might spend a bit of time talking about it. First of all, the mandate was set by Paul and the team. So how do we run these portfolios? Paul wanted to have this mix of active, passive and sustainable investing. It's an unusual mix to have everything in one portfolio, but we think it's an incredibly effective way to have diversification at a starting point by having these various different approaches. Mapped very closely to Moneyweb's advice process, incredibly important. As Matt talked about, the predictability is really what's so important. And then platforms, we work very closely with a lot of platforms. Currently with Aviva and Quilton, we're working with the guys to look at this new potential platform to help drive down costs. The second part is the collaboration, which really happens at the investment committee. You saw the members of the investment committee. We meet quarterly. We have a large pack. I'll show you a snapshot of the pack that we generate, which allows us to have a conversation about all the different aspects of markets, all the different underlying holdings in the portfolio, and for us to be grilled, as Paul's very good at that, on what's not working in the portfolios, and we have to make sure we have all the answers. And finally, reporting. Reporting is very important, we think. Information, we talked about service. For us, a lot of that comes through information, making sure that everybody's aware of what's going on, particularly when markets are volatile. Of course, when markets are going up, everybody feels more relaxed. But when markets are going down, when they're volatile, information sharing is very, very important to keep people understanding where the portfolios are invested, how we're spreading the risk. Those are the times when we think communication is most important. And so the mandate, first of all, as I said, is this mix of active, passive, and sustainable. What do we mean by that? Well, sustainable, of course, everybody understands sustainable investing, and we think it's very important. We're going to do a slot on that in a moment. Passive just means tracking the index. Very cheap way to invest, not always the best and not always the most diversified, which is why we like to include active as well, which gives us more levers, more diversification, more ways to smooth the journey to make things more predictable. And we have typically about a third of the portfolio in each part. We flex that depending on the conditions. At the moment, the mix is a little bit more inactive, particularly in the fixed income space, which has actually been in some ways the more volatile part of the markets for the last few years, particularly in 2022. So we're more active there, and then split equally between passive and sustainable for the rest of the portfolio. So this is how the committee works. We've since we last met, so we've met 4 times. It's a quarterly committee. We rebalance after each meeting, so we present a pack with our proposed changes. We discuss all of those changes. We get some pushback, some questions. We conclude on that. Then we make the trades. So we've made 26 changes to portfolios in the last 12 months. But there's something very important about this, and I think this year is a sort of poster child for that, is that although we meet just quarterly, we can make changes outside of those quarterly meetings if the world changes. And of course, this year we've had the volatility around Mr. Trump. And so that's been an important point. I'll talk about that in a moment, but just to show you a quick snapshot of the pack, this is the pack we produce. It's a very consistently produced pack. Actually, we use our technology to produce this pack to make sure there's no errors in there. It's very important to make sure we have very strong data to make sure there's no errors. And it's a way for us to talk about the portfolios, the split between the assets, the changes that we're proposing. So the clicker seems to be running out of juice. No, we're not. So I think I showed this last time, but it's a way to visualize the portfolio throughout the last year. So the way that it works, it's a video. I'll press the click on it in a moment. But in the center, the numbers are going to be, I know, a bit small for everybody, but the color's the important bit. In the center, you have the return of the portfolio, which is going to hopefully click up over the year. On the right-hand side, you have the equity part of the portfolio. On the left-hand side, you have the bonds, and then the alternatives sit in the middle. And as we click through it, whoops. Okay, we're off. So as we click through it, each change in the color is every week. So the darker the blue, the more positive the performance is. And as you can see, so we're now into close to the end of the year. We're starting into the January of this year. Everything is going well, and then suddenly, when we get to April, you'll see portfolios starts to sell off. Now, our job is to make sure it's as diversified as possible, but this is the Liberation Day moment where Trump announces the tariffs. Markets are very volatile. Limiting that downside is very, very important. But one thing that was I think, unique for what we've had since we've started working with Paul and the team was in that moment in April when markets were selling off, there was a critical decision to make, which is, do we respond and reduce risk because Trump policies look like they might trigger a recession, which is the most damaging thing for portfolios. And Paul and I had this conversation, said, we'll, if we need to, we will make a change outside of the normal schedule to change the portfolios and to reduce risk. But we decided that once Trump had reined in some of the tariffs, they weren't as bad as many had feared at the time, that the macroeconomy was actually stronger despite all the headlines than everybody feared at the worst point. At that moment, we decided not to make the changes. So sometimes changes are very powerful. Sometimes the most important thing is to do nothing, stay invested, and by the end of the year, the portfolios are up 10%. So a good example of how we work. It's a great partnership that we have with Moneyweb. But I thought I might talk about a couple of examples of where we have made some changes. So you won't be able to see the detail, but this is from the pack. It's one of the holdings that we have in the portfolio. We have two jobs in the portfolio, or really three. One is to think about the asset allocation, so the mix between the assets. Secondly, to think about how much to have in each asset, in each fund in this case. And thirdly, which fund to use between those active, passive and sustainable. And this is an active fund run by a company called Lindsell Train. Nick Train is the fund manager. He's got one of the best track records in the UK. And it started off in the portfolio 2 years ago when we first started working and investing in the Moneyweb portfolios. It was an addition to the portfolio. We track the managers very closely. It's a big part of what we do. One of the things that we were concerned about was that Nick Train has been running his portfolios for many years. The culture we felt was getting weaker. He wasn't thinking about succession planning. He was becoming much more obstructive. We felt that the answers were not as clear. And so a year ago, we decided to change this fund. The performance of this fund is in blue and the FTSE is in red. And as you can see, to begin with, they track together quite closely, but more recently, you can see how disappointing the performance has been. So it's a good example of where we've made a change. We don't get them all right, of course, but we think very carefully about all of the portfolio, all the holdings of the portfolio. When we become uncomfortable, we make the change and switch into a better manager. In this case, another manager we've known a very long time, extremely talented manager at Man. And you can see since we've changed, actually they're slightly ahead of the index, which is what we want from our active managers. And when you look at the two side by side, you can see the difference that it can make if you make those changes. The difference between the one we retained in blue and the one we sold in green. My last chart before I hand over to Will is something we've held, which is a fund we've held since the beginning. This is a fund run by one of the teams at Pacific, the Pacific North of South Fund. They are specialists in emerging market equities. They've been investing in emerging market equities since the 80s. And they have an incredible track record. They've outperformed 7 years in a row, which in our world is pretty hard to beat and pretty unique. They're great from our perspective for two reasons. One, because they generate this very consistent, very predictable performance, and also they're great people to talk to about what's happening in the world. China's become an incredibly important driver of the global economy. So a good example of something we've had in the portfolio since the beginning, and continue to be very happy with the performance. I may talk more about emerging markets later, but for now I'm going to take some questions. But for now I'm going to hand over to Will to talk about sustainability. Thanks very much. Best of luck with the clicker.
Thanks. Okay, great. So, with the final 15 minutes, I just wanted to touch on sustainability at PAM and why we think it's a massive opportunity going forward. And I think a lot of people, if you ask them about sustainability at the moment, wouldn't agree with that, and that's one of the reasons why we think it's so interesting at this point in time. Firstly, just on what PAM does around sustainability, it's something that we care deeply about, and that's one of the reasons when Matt is talking about culture with Paul and the Moneyweb team, we really gelled over this idea that sustainability is very important, not just from what you do around communities, but how you invest as a business and how you think about markets. So we are signatories at PAM to the UN Principles for Responsible Investment, which is a mouthful, but really what it's all about is assessing and auditing how we deal with sustainability issues across our business. So that goes from the investment decisions that Will and I make every day to thinking more carefully about how we use our office space and how we employ our workers and everything that goes into our business. It's around 300 to 400 questions, and when we answer at PAM, we rank in the top sort of 20% or more for each of the areas that we answer. Ooh, I think we might be dead on the old clicker. That's what happens when you get the graveyard slot, I guess. Okay, here we go. So the other thing I want to talk about is the UK Stewardship Code. So these are 12 principles that are laid out in the UK where every time you talk to a business as an investor, you want to drive change. So you want them to tell you more about their supply chains. You want to understand a bit more about their carbon budgets, how they're thinking about the world. And we do that at PAM. So we release a report every year. It's about 50 pages. It's posted on our website. And it goes through all of the information that we run through with businesses. And there are lots of case studies there. It's probably the biggest way that anyone can drive change in sustainability. And also, when we look to the future, we think that's really important for companies' profit margins and ultimately for the opportunity that exists within sustainable investing. So I'm going to run very briefly through the 3 pillars of ESG investing and then give an example. So firstly, environmental investing. Environmental investing isn't just about finding dark green companies, but really it's about finding companies that are best in class within each sector. So it's about thinking about the carbon budgets of those businesses and finding out who does something in a more efficient way. That's really, really important. When we think about what happened with power prices in 2022 in the UK, for example, if you can find a way to produce goods in a more cheap and more efficient way, you tend to benefit from that as a business. We're just thinking now about the deployment of AI and data centers. If you can deploy that power, which is growing at a dramatic pace, more efficiently, you stand to benefit in terms of the margins and the profitability of those businesses. The other way we think you can benefit is through being a better business from a social perspective. So if you can look after your employees, you tend to lose fewer employees, you have more skilled workers, that means you're a higher quality company. I think people often forget this. When you think about employee turnover, that tends to correlate with being a lower quality business. If you can retain those employees, look after them, give them healthcare, education, etc., it tends to indicate a higher quality business. And then the final element is governance. That's all about translating the way in which you pay, for example, your executive staff to those shareholders. It's about not taking advantage of shareholders and making sure that we get the returns that we deserve for investing in good businesses. So when we think about those 3 pillars, it's not all about sustainability in its purest form. It's really about identifying what we would consider to be high quality businesses. And so for us, we think that's a really, really sensible way to invest. For the team at Moneyweb, it is a diversifier within those core models that we think presents a unique way of investing and identifying companies that sort of hit these 3 pillars. We've obviously spoken about the trees that we plant, which we think is a really important thing to do. But the other way we can think about measuring sustainability, which might be hard to read at the back, is through the way in which we reduce carbon within the portfolios. So within the sustainability sleeve of the Moneyweb Balance Fund portfolio, for example, investing £500,000 equates to charging your phone 454,000 times. It equates to about 7 acres of tree planting, 780 gallons of petrol. And that's that carbon saving that you can generate from this portfolio. So for us, over the last 5, 10, 15 years, we've seen lots of people change their lifestyles to think a little bit more about sustainability, both from a social perspective and an environmental one. We often think that these pots of money that people are investing their pensions in are an amazing way to drive change as well as generate returns. I just wanted to give one other example. So this is a fund that we own within the Moneyweb blended model. So this is the Janus Henderson Global Sustainable Investment Fund. We think it's excellent from a number of angles. Firstly, the team have been around a very long time. They've generated incredibly strong performance over the last 5 or 10 years. They've been in place for over a decade. They identify what they call mega trends. So they think that the world is moving to a lower carbon economy. So they think we're moving there over time. And when we have these discussions with them, I'll let Elliot sort that out. We basically would tend to agree. So when we think about technologies that are being put in place at the moment, so I spoke earlier about AI, solar, the cost of solar pricing over the last 5 or 10 years has decreased rapidly. We are having a long discussion with Janus about how do you deploy energy to power some of these data centers. You need the cheapest energy source possible. How do we address some of the problems in the UK? You can do that through deploying solar. So those are the kind of discussions that we like to have with them. It's not just about whether it's good for the world, although I personally think that's important. It's about the fact that these are at the cutting edge of technology, and that's really what sustainability is all about. It's about driving that change and being much more technologically led. So we think that's very, very important. I think that's really it. That's all I really wanted to say on sustainability. We think, to summarize, it's a really important way to diversify the Moneyweb models. You have some allocation to active, some to passive, and some to sustainability. We have a pretty strong process at PAM for identifying funds that we think meet our sustainability goals. And I think the thing that you get with sustainability is access to those cutting edge technologies, those cutting edge stocks, where we think the theme will be in place for the next 10, 15, 20 years. So with that, I'll hand over to questions.
Thanks, Will. So we're going to open some questions up to the two Wills and to Matt and to any of the team from Moneyweb. So I'll go around and find anybody who wants to ask a question.
Historically, when shares have risen, gold's tended to fall. At the moment, gold's going bananas, shares are rising, and also the fees that government trying to pay for money are rising. Is everything going to go down at the same time?
That's a good question. Well, I think the reason that the gold price is going up is because markets are sensing that, particularly in the US, that what Trump is doing is a real risk to the dollar, and if government spending in places like the US doesn't remain under control, that ultimately assets will go up and money will go down. And it's one of the reasons it's so important to be invested over time, because governments over time, money loses value after inflation over time. And that's really what this is saying. It's a concern over that. And we've seen this before in the past. It doesn't necessarily mean they'll all go down together, but it's a bit of a warning sign to say that some governments, particularly the US the deficit of the US is far beyond what's happening in the UK every year. And Trump is pushing that way beyond anything else ever done before. And the gold price is reflecting that. But I wouldn't necessarily say it means that everything's going to fall together. It's a sign of some of those risks. Good question there.
It seems to me, as a sort of a, if you like, a normal everyday person, that the momentum, particularly toward net zero, seems to be slowing down. Is that sort of filtering through to organisations, companies, etc., in effect slowing down also on their sustainable goals?
That's another really good question. I would say, in context, the experience over the past 5 years of sustainability, just in investing terms, has been really, really interesting, because in 2020 and 2021, we had this really elevated peak of sustainability expectations. And then suddenly, when we had interest rates rise and inflation problems, those have completely re-rated back down. So how would I characterize how companies are tackling this challenge? I mean, I think firstly, just from the perspective of their commitments, I think from institutional investors, particularly in Europe and less so in the US, they're still demanding lots of information, lots of science-based targets, so reduction in overall carbon, all of those kind of metrics. And then for the sustainability specific stocks, we've seen really depressed valuations. One of the reasons we're quite excited about it is actually we're starting to see a turn up in the level of deployment of solar or wind or any one of these sort of technologies, and actually from the valuations that they're at, they're kind of starting to perform now, which is quite contra, I think, to a lot of the headlines, which is why it's so interesting. Often it's during those peak of deflated expectations or elevated expectations that you find an interesting idea.
Well, I think the other thing with technology is that everybody tends to overestimate the short term and underestimate the long term. That's what happens with every technology. If you're bored, there's something worth Googling called the Gartner hype cycle. And the Gartner hype cycle talks about a technology trigger that creates this mass influence of cash, inflow of cash, which then creates a peak of inflated expectations. And then you end up with this trough of disillusionment. Think the internet bubble of late 90s, early 2000s. 2000 peak of inflated expectations. Then you end up with this trough of disillusionment. That means there's a big supply shakeout. Then the companies that are there create pricing power. It's everybody's unloved, and then suddenly the technology catches up. And then you get this thing called the slope of enlightenment. And if you actually look at what happened after the tech bubble, if you'd read the Amazon report in late 1990, it wasn't nearly bullish enough, even though everybody thought it was crazy. And I think a big opportunity for us over the next decade is that you're getting in at very low valuations when it's undeniable that there will be an energy transition and opportunities going forward. But the thing is, these things, they were pricing in 10 years of opportunity in 2 days. One could say they're doing this in AI. But ultimately, it will make a difference. It's just take a long term and sticking through it, which means it is a fantastic way of getting diversified returns. So we remain excited as a firm for it.
Anybody else? Any questions?
Just a quick one. I was interested with the tariffs in Trump era, and there's now reports that Europe are going to throw tariffs at us. Is that going to affect the dip in our performance, do you think? Or are you taking actions to limit that impact?
Sorry, if Europe takes applies tariffs to the UK?
Yes.
Yeah, it's a good question. I mean, I think what I would say is we talked about headlines and markets, and it's very important to separate headline news and market returns. I mean, clearly, any tariffs in the UK would be a hindrance to the UK economy. But it's one of the reasons that we invest globally. We make sure we spread our risk for exactly those sorts of problems. There's always problems in the world somewhere. The news in the UK is pretty gloomy at the moment, but it's worth remembering that the portfolios are very broadly invested across globally, and even the UK companies are mostly global businesses rather than just domestic businesses. Sometimes it's great to invest in small companies in the UK that are domestic businesses. Sometimes it's better to be more global. At the moment, we have a bit of a preference for more global businesses. But I would say, yeah, it is a threat, but we think about those sorts of risks that sort of come from nowhere. That's why we spread our risk around.
The other thing about the UK is it's quite an investable country. I know it sounds crazy with maybe certain leadership and all those other things. but we won't talk about politics. But, you know, look what's happening in France. You know, look at the debt that's across Europe. Look at Germany's manufacturing culture, which is going to get absolutely nailed by what Donald Trump is trying to do. And there's big geopolitical risks. There's issues around Ukraine. There is a lot of populist governments that are have already happened in the UK to a certain extent. You know, we flirted with Boris, and then we had Corbyn, and we've been at either ends of those spectrums. Farage is there maybe, but actually from a legal system, we end up with quite a stable currency, quite a sensible legal structure. We're quite aligned with the US. So as a country, although the headlines are always quite horrible, from an investable perspective, we're probably more investable than many parts of Europe, and more predictable. So I think there is hope.
Just while you got that mic there, Matt, so I got a question in from a client who couldn't make it. Well, I've got 4 questions actually, but this one's quite pertinent to you, I think. So his question is, clearly over the past few years the portfolio has been performing really well, and I guess that's down to personnel managing the returns. What happens if key personnel leave or they're absent from the business?
You're trying to get the Wills a pay rise. Right here. We're a partnership, we are partners. I'm not Will's boss. We work together to try and build a business. I'm responsible for building a business. He's responsible for running money. And Will's a partner. The other Will's a partner. So we feel we're all invested personally in all the models that we run. 100% of my SIP is run by Will. I think 100% of Will's brother's SIP is run by Will. So I think we're aligned. I think if that alignment goes, that's why you get turnover. And I think, you know, if we can maintain the culture and the alignment, then people don't leave. If Will was to get hit by a bus, or Will was to leave because he decided this wasn't what he wanted to do, as you can see, there were 3 slides of people there. And that's why another reason why risk management and maths is so important, because it's not just about people, it's also about a process. And as a firm, we've built a process. So I think we never want the Wills to go anywhere, but we would hopefully survive.
Thank you. And if one of the Wills can answer this, so this is another client email that's come in, couldn't make it tonight. I'm very pleased with the performance of my Moneyweb Balance portfolio since PAM started running the portfolio, and all funds have been showing positive growth apart from the L&G S&P 500 US equal weighted fund. Why do you continue to invest in that?
This is the sort of question we get at the IC committee, I have to say. Paul likes to go down the list and find the worst performer and then ask me why we still hold it. I mean, it's a good question. We know, why do we hold things that, should everything be winning all the time? This particular investment is a very simple idea. Rather than owning a tracker fund for the US stock market, it owns all the stocks in the S&P 500, the 500 biggest stocks in the US, but it owns them in all the same proportion, all the same weight, all at 0.2%. And the reason it's not done as well as the main index, which we also own, is because the biggest companies have done the best. But the US stock market is quite concentrated in those biggest companies. In fact, it's never been more concentrated. And for the moment, that's a great thing because the biggest companies have been doing the best. But that doesn't always remain the case. So we like the idea to have an allocation to some of the greatest companies in the world, but not have all of our money in a few companies to spread the risk around.
Well, statistically, how much of that S&P 500 is those 7 technology stocks?
Well, it's about 35% in 7 companies. So it's a very large, it's an unusually large amount. I would also say it's up 30% since we bought it, so it hasn't gone down.
Don't get defensive.
But it hasn't done as well as. Don't get defensive. Okay, I'll leave it there.
Final question from clients that couldn't come. Maybe if you pass the mic on to Will, you could maybe have a go at this one, Will. What do you think is the biggest risk to the performance of the portfolios over the next 12 months? And also, what's going to be the biggest opportunity?
That's a very good question. I think the biggest risk is ultimately a recession. as we know in recessions, the earnings of companies, which is ultimately one of the most important drivers of returns, tends to fall. People lose their jobs, etc., etc. I won't, go through the gory details. I think the good news is, at the moment, we don't think, particularly in the US, which is the most important market, we don't think we're too close to a recession. The labour market looks okay, consumers look quite reasonable, and they've got this boost from all this spending in AI. But a recession is certainly something that we're constantly watching the data for, because we know that's the period that, for us and for clients is the least comfortable. That's when you tend to get the drawdown. The biggest opportunity, I think that's a really good question. I think something that we've been really interested in at the moment is emerging markets. So Will spoke a little bit about it. We obviously have the holding in the North of South Fund, which has outperformed every year for 7 years. So standalone, it's been a brilliant performer. But in markets like China, markets like Brazil, that have been underperforming for a long period of time, what you tend to see when the dollar starts to fall is these markets can perform very, very strongly. And in their own terms, these economies are growing reasonably well. They've borne tariffs, they've been okay in the face of tariffs so far, and actually they're growing their economies very sensibly. And they don't have the debt problems that we see in a lot of the developed markets like France and the UK. So for us, I think we're really excited about that.
Thank you. Any more questions?
Why are there so few females amongst your faculty?
Oh, gee whiz, that is a tough question.
You better come down here quick.
Yes, good.
I didn't mean yours, Paul, I meant theirs.
Yes. 30% of our workforce are females. We have 7.
Workforce.
Yes, we have.
But in your investment committee, there was one.
Yes, we have 17 different nationalities in the business, and the 2, I think, of the board of the senior management team are females as well. So it's probably not a fair representation of the firm as a whole, but it's something that's important.
I mean, the answer is we would love to have more women in our organisation. So we have an intern program every year. The rest of the business chooses interns from anywhere. Anyone's able to apply on LinkedIn. But the investment team, we only hire women in the investment team. We work with an organisation called Girls Are Investors, a brilliant organisation. We get incredible candidates. One of our most exciting. We love the programme every year. They've just left us a couple of months ago, and we hope we have a joiner this year from an intern programme a couple of years ago in a different department, and we very much hope someone will come back and work with us. But you're absolutely right to point it out. We do try.
Yeah, and just to add, the last thing I'd say is we do have the Diversity and Inclusion Committee, where our feet get held to the fire on this issue 100%, which is absolutely right.
Can you share?
Yeah, really quick one. Just in the running of your company and the risk posed by cyber effects, does that keep you awake on the night?
Yeah. Yes. The answer to that is yes. It's fortunately kept me awake at night for a very long time. So we do penetration testing every quarter. We have an external firm that comes and tries to hack into our system, which is quite a fun thing, I suspect, for them. We have a cyber security committee. Everything we do is cloud-based, which means that we have the ability to turn it off and back up all the systems extremely quickly. We have more technologists in the business than we have sales guys or investment people or fund managers. So technology, as I mentioned earlier, is massively important to us. So it does keep me up at night. I think it's also important that for you guys, we don't have retail permissions. We cannot run individuals' capital without a pool. We see one client, which is effectively Moneyweb, not to throw you under the bus here on your cyber security, and all of the money that we run is custodied either on Aviva or through Citigroup, which is our administrator and custodian. So the cybersecurity would obviously, the cyber risk would obviously be a disaster because it would show that we weren't as good as we think we should be on that space. But in terms of those financial assets, we don't custody any of them. That's when you have recourse to Citigroup or an independent management company in Ireland called Waystone, which is the largest manco in Europe. So our auditor is Deloitte's, our administrator is Citigroup, and Waystone's our independent management company. So we put all of those service providers in place to make sure that even if something did happen, there's about 3 or 4 backstops that makes sure that capital is always protected. So we take it very seriously. We do a lot of work on it, and it will continue to keep me awake, I suspect.
Cool. I'd just like to personally thank these guys for coming up tonight from London. Come a long way. Set off early this morning. We've had a meeting this afternoon with them. They love coming up here. They love to speak to you. They're going to hang around for a bit. So you can have a beer and you can have a bite to eat. If you want to collar them and ask any questions, I'm sure they'll be delighted to speak to you. Personally, thank you all for coming. There's more and more people coming to these events, which is really pleasing for us. Obviously, you guys are getting something out of it, so I think that's a good thing. So thank you very much for coming, and thank you guys for attending.